Hi everyone, welcome back to another lesson. If you're new to this channel, my name is Farhan and I help accounting students like you ace your exams. Today we have got a practice question from 2020 October-November past exam, and this is mainly paper 2 for the subject code 0452. Now, even though you are a student for the subject code 0985, it's essentially the same syllabus, same stuff, just that you guys are sitting exams in different time zones. Now, in this question today, we look forward to correcting errors, and then after the correction, we calculate the revised profit, followed by the preparation of financial statements, such as the statement of changes in equity, and lastly, the balance sheet. You can see the question on the left-hand side of your screen, and you can see all the workings on the right-hand side, which I'll go through and explain to you step by step. What I need you to do now is focus and follow through for an excellent understanding. With that being said, let's begin. The directors of DW Limited provided the following information at 30 September 2020. So here you can see that we are provided with a list of balances for various items such as assets, liabilities, and equity. And we are also provided with some additional information at the end of the year for adjustment purposes, such as the discovery of 3 different types of errors, and also that a draft profit of $84,900 that has already been derived prior to the correction of these errors for the year ended 30 September 2020. The requirement in Part A is to calculate the correct value of inventory at 30 September 2020. Now, how do we value inventory? Inventory is valued at the lower of cost or net realizable value. Now, what do we understand by the cost? The cost is the price that you have to pay to your supplier to buy this inventory and bring this inventory into your business, which could be the total of the purchase price you're paying to your supplier and the carriage inwards, which is the cost of transportation of these goods into the business. So this is the cost of the inventory. But when we think about the net realizable value, it is simply the difference between the selling price and all costs that are required or are necessary to sell this inventory. All right. Now let's look into the first error which we are given. Inventory of $26,300 included items valued at cost of $5,200 needed repair. After repairs costing $600, the items could be sold for $5,000. So what we can understand is that in the list of balances provided to us here, the amount for inventory at 30 September 2020, which is at the end of the financial year, is given to us at $26,300. Within this $26,300, we had items which we originally purchased for and brought into the business for a total of $5,200. That is the total cost for these items. But these items need some kind of repair. And the cost to get these items repaired is $600, and after the repairs are done, only then these items are fit for the purposes of selling, and they can only be sold for $5,000. Okay, now what have we just talked about in terms of the net realizable value? It's simply the difference between the selling price and all the costs that are necessary to get this inventory fit for the purpose of selling, which in this case would be the repairs expense of $600, right? So the net realizable value is derived as the difference between the selling price of $5,000, which is given to us in the additional information, and subtracting the $600 in repairs cost, which ultimately gives us a net realizable value of $4,400. So this inventory had an original cost of $5,200 to buy it from the supplier, but the net realizable value after the repairs are done is $4,400. Therefore, the correct value for these items to be adjusted within the financial statements would be $4,400 in place of $5,200. So how can we achieve that? So to correct the inventory balance at 30 September 2020, we start with the unrevised balance or the unadjusted balance of $26,300 prior to corrections. Then we deduct the cost component for these items, which is $5,200, followed by the addition of the revised value for these items to be $4,400 after the write-downs have been processed. So that gives us an ending inventory value at 30 September 2020 to be $25,500, and this is the amount you report in the statement of financial position as part of your current assets, and also include as part of your cost of goods sold calculation ending inventory balance when you prepare the income statement. All right. So the first requirement was to calculate the correct value of inventory, which is $25,500, as we can understand. And based on whatever we have just done, we can understand that we have written down the value of inventory from 26,300 to 25,500, right? So which means the amount that these inventory items have been written down by is $800. And this is a loss that we have to incur as a business, right? Which would be processed as an expense through the income statement. So therefore, our expenses are going to increase. And when we increase our expenses, our profits are going to take a hit. Therefore, the profits will go down, okay? Now let's do the second part of the question, which is to calculate the revised profit for the year ended 30 September 2020 after adjusting for errors 1, 2, 3. So error number 1 has already been processed, as we have just discussed. Now let's look into error number 2 and error 3 before we can calculate the revised profit. Now error 2, operating expenses included insurance of $400 that was prepaid at 30 September 2020. All right. So what we can understand is that in the financial statements or in the books, we had operating expenses recorded, but that amount was overstated by $400, which is not really an expense incurred, but rather a current asset. How can we confidently say that? Because it includes the word prepaid. So which means you have paid in advance for an expense that you will incur in the next financial year that starts 1 October 2020. But we are mainly interested in everything that has occurred for the business during the financial year ended 30 September 2020. So we are looking for transactions from 1 October 2019, which would be the beginning of the financial year, all the way until the end of 30 September 2020, right? Now, within this financial period, 12 months, the operating expenses have been incurred, but the current asset for insurance prepaid of $400 had been incorrectly included as part of our operating expenses. So now what do we do as correction? We have to reduce the expenses by $400 that we will report in the income statement and simultaneously increase our current assets, mainly our prepaid insurance or other receivables, by $400. And we understand that when expenses are going down, profit, due to the inverse relationship it has with expenses, will now go up by $400, okay? All right, so as part of a revised profit calculation, this is definitely going to be added because it's increasing profit. Now, what about the third error? The provision for doubtful debts should have been adjusted so that it equals 5% of trade receivables. Now, provision for doubtful debts is a precautionary measure that we take for credit customers to whom we have sold our items on credit, and these customers had promised to repay us at some time in the future. Now, it is likely that few of these customers may not be able to pay, so we take a precautionary measure, mainly due to the accounting concept of prudence, which requires us to not overstate assets and to not understate expenses, okay? So when we derive the provision for doubtful debts at 30 September 2020, it is an estimation of the amount that we may not likely collect from some of the credit customers. And in this case, it is to be applied at 5% of the total trade receivables of $14,500, which is given to us in the list of balances here. That is $14,500, okay? Now, before you always apply the provision for doubtful debts, which in this case, we are simply multiplying 5% on the trade receivable amount of $14,500. In some cases, you may also come across scenarios where the irrecoverable debts are included. Now, you have to carefully scan through the question and see if you have forgotten to deduct the amount for irrecoverable debts from the gross amount of trade receivables already provided to us in the list of balances before you can calculate the provision for doubtful debts by applying the given percentage, okay? Now, in this case, if you take a quick look, you will know that there are no irrecoverable debts. But again, this is only so that you don't make mistakes in questions that have irrecoverable debts included. So provision for doubtful debts at 30 September 2020 is therefore 5% multiplied with $14,500, which is $725. and this is the amount valid at 30 September 2020. Now, when you go through the list of balances provided to us, you will find the provision for doubtful debts already mentioned for the 1 October 2019, which is the beginning of the financial year, and that amount is $625. Now, compare this to the ending balance we have derived of $725. This clearly indicates an increase in the provision for doubtful debts. So now it is such that we now expect to not recover more of the amount as compared to the previous year in terms of the credit sales we have made to credit customers. So this is kind of like a bad thing, so which we classify as an expense. So this increase in provision for doubtful debts is $100, which increases our expense. And when expenses increase by $100, profit will definitely take a hit and go down by $100. Okay. Now, so let's find the revised profit on that basis. So we are starting with the draft profit or the adjusted profit given to us here in the first sentence of the additional information. And then we're adding 400. Why? This is for the correction of error number 2, where expenses have to go down by 400 and therefore profit went up by 400. Then for error number 3, what we're doing, our expenses are increasing by 100, therefore profit must go down by 100. Therefore, we are subtracting 100. And then for error number 1, we are subtracting 800 because we had inventory reduced by 800, which is an expense, and therefore will decrease our profit. Okay. So ultimately, the revised profit is simply $84,400. All right. Now, make sure to do all the workings in the exam. And the way we are going through all these questions is to ensure that you understand all the complications that can be involved in the question and to score the maximum results possible, which is mainly to score a full 20 out of 20. Now, let's go to part C. Prepare the statement of changes in equity for the year ended 30 September 2020. So we were already provided with an outline. And in this question, we are given 3 forms of equity, which is mainly the issued ordinary share capital, the general reserve, and the retained earnings. And in most cases, in your exam, you would likely come through all these 3 forms of equity. Now, to begin the financial year at 1 October 2019, we are starting with the opening balances, which are given here for general reserve to be 6,500, issued share capital to be 200,000, and the retained earnings to be 73,475. So on 1 October 2019, these are the 3 amounts respectively, which we have included here. And these 3 forms of equity added together gives us a total of 279,975. Then equity can move throughout the year, mainly when we make profits or we incur losses. So now that we know that we have a profit, which is the revised profit of 84,400 that we've derived in part B, that will increase the retained earnings. Why? Retained earnings simply refers to reinvestment of profits. All right. So when you have made profits, it is going to increase the retained earnings. So that's why we include this amount in the retained earnings column, and that will also be reflected in the total column. Then we subtract the dividends that we're paying for the year. Now, dividends refer to share of profits, which are given to shareholders for their generosity in terms of the capital and the investment they have provided the company to run their operations and make business, right? So the dividend paid is the 3rd item in the list, which is $2,000, as you can see here, right? And dividends, as we have already discussed, is a share of profit. Therefore, it must decrease your profit. Therefore, it should be included in the retained earnings column. So in the retained earnings column, we are including it as a negative number by showing it within brackets, which should also be reflected in the last total column. All right. Then if you read the very last line, this very second last line, the directors decided to transfer $5,000 to general reserve. And there was no change to the issued share capital during the year ended 30 September 2020. Okay. Now, when we're transferring a general reserve, it's just simply moving money from one form of equity to another form of equity, which in this case is to move money from the retained earnings account to the general reserve account. So therefore, in the retained earnings account, we are deducting 5,000. That is why it is within brackets. And in the general reserve account, we're adding that $5,000. Okay, so this is just a simple transfer where equity is not really decreasing as a whole, just that within the equity, there are different forms. And it's just moving money from one form to another form. So that is why, as part of the details we have written, it's simply transfer to general reserve. And that is it. You just simply add each of the columns individually. So when you add the total for share capital, the closing balance of 30 September 2020 is 200,000. For general reserve, it's 11,500. For retained earnings, it's $150,875. And altogether, this tree adds up to give us $362,375 as the net equity available in the business. Okay. All right. Now, what's the last thing to do? So the last requirement in this question is to prepare the statement of financial position at 30 September 2020, which is the balance sheet. And the balance sheet is mainly the entire fundamentals of accounting, which is the accounting equation that is the total of assets must equal the total of equity and liabilities. This also refers to the fact that all the assets and all the resources that you've got in your business is either financed through your equity or through going on debt, such as the liabilities, debentures, buying an asset on loan, etc. Now, let's start our financial statements with the assets. And there are two types of assets, non-current assets and current assets. Non-current assets are those assets which we want to use in our business for more than one financial year. These assets generate long-term benefits for the business to help the business generate more revenue and increase efficiency in operations. Current assets are those assets which are short-term in nature, mainly within the next 12 months, where we expect to capture some kind of economic benefits for our business. Now, to start this financial statements, we are including the three different components for the non-current assets. So the cost, the accumulated depreciation, and the net book value. Now, the accumulated depreciation simply refers to the total depreciation expense we've got so far for all these non-current assets since the day of purchase. All right. And the net book value is derived as the difference between the cost and the accumulated depreciation. And the net book value is reflective of the economic benefits still available for consumption within these non-current assets that are available in the business. Okay. Now, so we report our non-current assets at cost, which is $462,000, which if you scan through the list is here. So you can see non-current assets at 30 September 2020, the cost is given at 462, and the provision for depreciation, which is the total depreciation expense so far, $106,000. So those are the two amounts we've included here, and the net book value of $356,000 is simply the difference between those two amounts. Then we've got all the current assets that we want to list, starting with inventory at 30 September 2020, which is the revised amount of $25,500 after the write-down of $800 was processed, if you recall from our session earlier today. Next, we have got the trade receivables gross amount, which is $40,500, as mentioned in the very last line item in the list given to us in the question at the beginning. And then from that gross amount of trade receivables, we subtract the provision for doubtful debts we derived at the end of the year, which is $725. That subtracted from the gross amount of trade receivables gives us $13,775 as the net amount of trade receivables. And then we've got other receivables. This is $2,000. In the list is given to us as $1,600. But if you remember, we did have insurance prepaid of $400, which increases the current assets for the business. Why? Because we paid for this insurance in advance, which means we still have not consumed the economic benefits. But these economic benefits are to be consumed within the next 12 months, right? Therefore, they're included in our current asset. So the net amount for other receivables is $1,600 plus $400, which is $2,000. All right. Now, the total for all these current assets combined is $41,275. Okay. And then the total current asset is simply added to the total of non-current asset, which gives us the total assets to be $397,275. Now we report everything that's as part of our equity and liabilities. So we make a heading here for equity and liabilities, and we start reporting all the equity we have got. So we had three different types of equity from the statement of changes in equity, right? And those were the issued share capital, the general reserve, and the retained earnings. And these are the ending balances we derived after all the information had been processed. So those are the three dollar amounts we have included here. And when we add these three amounts, we get 362,375 in total value for equity, as we had already seen in Part C. Now, then we include our non-current liabilities. Now, for non-current liabilities, it's only the first line item given in the list, which is the 6% debentures of $18,000, right? So debentures refer to a long-term loan that the company has taken, and this loan is $80,000. The 6% mainly refers to the interest rate that the company will incur on this loan, which is a finance cost. Obviously, nothing is free in the world of business. And 2028 is mainly referring to the year in which this long-term loan will have to be repaid. Now, non-current liabilities, as we understand, is to be used within the business for more than 12 months. And that's why the year 2028 is important. So that amount is $80,000, as we have included here. Then we report all our current liabilities, and we have got trade payables of 8,250, which who are the credit suppliers of the business. And then we've got other payables of $2,200. It could be any accrued wages or accrued electricity or accrued rent, which refers to an expense that you've already incurred, but you have not paid the bill yet. And lastly, we've got the bank overdraft, which is 6,450. Bank overdraft simply refers to the fact that you've got a bank account, and in that bank account, normally we expect a surplus of money, which would be a current asset. But in this case, you had withdrawn more than what you originally had in the bank account. All right. And that amount is 6,450, which means you owe money to the bank. You must repay the bank. And this is a current liability because bank overdrafts are always short-term in nature. All right. So the moment you would make a sale in the next financial year that would surpass the volume, that would surpass the dollar amount for this bank overdraft, it would immediately bring it back to a positive balance, right? But at the moment, it is a current liability. And the reason it's a current liability is because, as we understand, it's short-term in nature. And as business makes more sales, this amount will eventually be rectified and increased and stuff. So the three totals for this current liabilities are 16,900, which is now added to the non-current liability of 18,000, which is then added to the equity amount of 362,375. That gives us a total equity and liabilities of 397,275, which matches exactly the total for our assets and therefore validates the accounting equation. And we know for certain that this math is 100% correct. And that's exactly how you score a perfect 20 out of 20. Now, if you found value in this content, make sure to drop a like, subscribe to this channel, share this channel with your friends, post in the comments on what topics you would like me to cover, and also check the description for links to apply to work with me. It is a highly intensive and selected program, and it can definitely improve your lives for a better future. With that being said, I'll conclude today's lesson, and I'll see you in the next one.